Hello everybody, once again I welcome you to this episode of my tutorial video series. This video is on application of marginal costing technique in profit planning and decision making. Now marginal costing is a technique that is used by the management to make decisions in various situations. Which is the technique of marginal costing? The technique is cost volume profit analysis or CVP analysis. I have taken a numerical example with which I shall explain how the CVP analysis technique can be used by the management in evaluating a decision to change sales mix of the products the firm is producing. Right? Now look at this example, numerical problem. A firm is producing three products, product A, product B and product C. Sales of the three products are 150,000, 90,000 and 60,000 respectively. The variable costs are 120,000, 62,000 and 36,000 respectively. Total fixed cost is 40,500. Now what is required? It is required to make CVP analysis to show how the profit can be increased by changing sales mix without increasing total sales. This means the firm wants to change the mix of the products they are selling without any change in the total sales. Now two things are worth noting. Number one, sales mix is being changed and total sales is not being changed. When a firm will change the sales mix, when some products are less profitable and some products are more profitable and there is demand in the market for the more profitable products, only then the firm can think of changing the sales mix. Now what does it mean by without increasing total sales? The firm does not want to increase the total sales. That means the firm does not want to deploy additional resources. Instead of deploying additional resources, the firm wants to withdraw some resources from the less profitable products and deploy those resources to the more profitable products. Correct? Now let us see what is the present profitability and what is the proposal of the management. This is present profitability. That is the profitability before changing any sales mix. A, B, C and here it is total. Correct? What are the sales figures? 150,000, 90,000 and 60,000. So the total sales is 300,000. Now from sales we shall deduct variable cost. That is the basic formula of marginal costing. That is sales minus variable cost equals to contribution, and contribution minus fixed cost is equal to profit. So we deduct variable cost here. So less variable cost. What are the variable cost figures? 120,000, 63,000 and 36,000. So the total is 219,000. Yeah, 219,000. Okay. This sales less variable cost, so we get contribution. Contribution is 30,000. Here it is 27,000, and here 24,000. So the total contribution is 81,000. Correct? These are the sales of the three products: 150,000, 90,000 and 60,000, totaling 300,000. These are the variable costs of the three products: 120,000, 63,000 and 36,000, totaling 219,000. We have deducted variable cost from sales, which is the basic formula of marginal costing, and we get contribution margin. For A it is 30,000, for B it is 27,000, and for C it is 24,000. So total contribution is 81,000. You can find it out either way, either deducting this from this or adding these three. You will get the same figure. Now sales minus variable cost is contribution, and contribution minus fixed cost is profit. So at this stage we shall deduct the fixed cost. And what is the fixed cost? 40,500. So less fixed cost. This is 40,500. Contribution minus fixed cost is profit. So profit is 81,000 minus 40,500. That gives us 40,500. So the present profit is 40,500. Now since the firm wants to change the sales mix, we have to find out the PV ratios of individual products. PV ratio, which is contribution by sales. C is contribution and S is sales. Here it is 30,000 divided by 150,000 into 100. For product B it is 27,000 divided by 90,000 into 100, and for product C it is 24,000 divided by 60,000 into 100. So this is how much? 20%. PV ratio of product A is 20%. And let us see what is the PV ratio of product B. That is 30%. And PV ratio of product C is 40%. Right? These are the PV ratios of the three products. So you can see product A is giving least contribution to the firm and product C is giving maximum contribution, highest contribution, and product B lies in between A and C. So the firm can reduce the production and sales of product A and distribute that sales into product B and C. So the firm proposes, the management of the firm proposes that $60,000, say it is dollar, you can choose any currency you feel like, sales of A should be reduced and distributed between B and C. The management of the firm proposes that sales of product A should be reduced by $60,000 and that should be distributed between product B and product C in the same ratio. That is 1:1 or 50% each. Right? So total sales will remain at 300,000. So the firm will not have to deploy any additional resources. So the firm will not have to incur additional expenses on fixed cost. There will be increase in variable cost of the products whose production is being increased, but at the same time their sales will also increase. As a result, contribution margin will increase and ultimately profit of the firm will increase. Okay, so let us see if the proposal of the management is implemented, that is sales of A is reduced by $60,000 and the same is distributed between product B and C in equal ratio, that is 30,000 each. This means sales of A will fall by 60,000 and sales of B and C will increase by $30,000 each. Now we shall evaluate this proposal. Now evaluation part I am doing here. This is evaluation. A, B and C, three products. Sales, present sales of A is 150,000. So new sales will be 150,000 minus 60,000, that is 90,000. Sales of product B is 90,000 at present, so it will increase by 30,000, so it will become 1,20,000. 120,000. In the same way, sales of C will also increase by 30,000, so it will become 90,000. And total sales will remain at 300,000. Okay. Now we shall deduct variable cost. You see, PV ratio is 20% of product A. This means variable cost is 80% because we know variable cost and contribution are complementary to each other. That is, variable cost percentage plus contribution percentage is equal to 100% sales. So if 20% is contribution, then variable cost is 80% in case of product A. In case of product B, PV ratio is 30%, that is contribution is 30% of sales. This means variable cost is 70% of sales. And in case of product C, contribution is 40% of sales, that means variable cost is 60% of sales. So less variable cost, here it is 80% of 90,000. Here it is 70% of 120,000. And here it is 60% of 90,000. Okay. So this is equal to 72,000. Here it is 70% of 120, that means 84,000. And 60% of 90,000, so this is 54,000. So what is the total variable cost? Let us see what it comes to. $210,000. So total variable cost after the change in sales mix is 210,000. So what is the contribution? $300,000 minus 210,000, that is 90,000, less fixed cost. How much is fixed cost? 40,500. It is not changing. The firm is not deploying any additional resources, so there is no change in fixed cost. Fixed cost remains at 40,500. So this is 40,500. So what is the total profit? $90,000 minus 40,500. $49,500. So before changing the sales mix, the total profit was 40,500, and after change of sales mix, total profit is 49,500. This means total profit of the firm is increasing by 49,500 minus 40,500. So increase in profit as a result of implementing the decision of the management. Increase in profit is equal to 49,500 minus 40,500. Correct? This is equal to 9,000. Say $9,000. So by implementing the decision of the management to decrease the sales of A by 60,000 and distributing that sales of 60,000 between B and C in the same ratio, the profit of the firm is increasing by $9,000. Hence, the decision is quite feasible. The management can implement this decision. Okay, this is the present profitability. Sales 150, 90, 60,000, that is total is 300,000. Less variable cost 120,000, 63,000 and 36,000. So total contribution is 81,000. Contribution of product A is 30,000. This minus this. Contribution of product B is 27,000. This minus this. And contribution of product C is 24,000. This minus this. So total contribution is 81,000. And fixed cost is 40,500. So profit is 81,000 minus 40,500. That comes to 40,500. This is the present profit. Now, since the firm wants to decrease the sales of the less profitable products and increase the sales of more profitable products, we need to find out the PV ratios. So we have found out the PV ratio, which is contribution by sales, and we multiply that by 100 because it is expressed as percentage of sales. So C by S into 100. So PV ratio of product A is 30,000 by 150,000 into 100, that is 20%. PV ratio of product B is 27,000 by 90,000, that is 30%. And PV ratio of product C is 24,000 by 60,000, that is 40%. So we see that product A is giving least contribution and product C is giving highest contribution, and product B lies between A and C. Now the management proposes that 60,000 sales of product A should be reduced. That is, sales of product A, which is 150,000 at present, should be made 90,000, and 60,000 sales will be distributed between B and C in equal ratio, that is 1:1. That is 30,000 each. B and C will get 30,000 each in terms of sales. So total sales of A becomes 150 minus 60, that is 90,000, and sales of B and C will increase by 30,000 each. So sales of B becomes 90,000 plus 30,000, that is 120,000. And sales of C becomes 60,000 plus 30,000, that is 90,000. Now we have seen the PV ratios of the three products are 20%, 30% and 40%. We know that contribution and variable cost are complementary to each other. That means if PV ratio is 20%, that is contribution is 20% of sales, then variable cost is 80%, 100 minus 20, 80% of sales. Here it is 70% and here it is 60%. So from sales figure we have deducted the variable cost. Here it is 80% of 90,000, that is 72,000. Here it is 70% of 120,000, that is 84,000. And here it is 60% of 90,000, that is 54,000. So total is 210,000. Total variable cost, this plus this equals to 210,000. So we get total contribution 300,000 minus 210,000 equals to 90,000. Fixed cost remains unchanged. There is no change in fixed cost because the firm is not deploying any additional resources. So fixed cost will remain unchanged. So we deduct fixed cost from contribution, we get profit. 90,000 minus 40,500 gives 49,500. Correct? So before the decision of changing the sales mix, total profit of the firm was 40,500. And if the proposal to change the sales mix is implemented, then the firm is expected to earn a profit of 49,500. So there is an increase in profit by 9,000, 49,500 minus 40,500 is 9,000. So by implementing the decision, the firm can increase its profit by 90,000, which means increase in cash flow too. So the decision can be implemented. It is a feasible proposal of the management. So this is all about this problem, that is profit planning by changing the sales mix of the products. Some products are less profitable and some products are more profitable. So the firm is reducing the sales of less profitable products and redeploying the resources that is withdrawn from the less profitable products to the, not fully withdrawn, it is withdrawn to some extent, because the firm is not altogether withdrawing this product line. The firm is not doing so. Why? Because there is still some demand in the market for product A. And also, the firm cannot increase sales of B and C to a very big extent because of demand constraint in the market. So sales of A is reduced by 60,000 and that is distributed between sales of B and C in equal ratio, that is 30,000 each. And by doing so, the firm is expected to earn higher profit by $9,000. Hence, this decision is viable and the management can implement that decision. Correct? This is all about profit planning by changing sales mix. I hope so far it is quite understood. I think you have enjoyed this video. I mean, the video has benefited you or will benefit you, and if you think so that the video is useful and meaningful, then please do share the videos with your friends so that they can also be benefited by watching the video. At the same time, I will request you to subscribe and like our channel, and also please do send your comments, your queries, your doubts, if any. Okay. Thank you for watching this video. Goodbye and stay well.